Here's a tax loophole that billionaires use that all small business owners need to take advantage of right now. One thing that billionaires understand that small businesses don't is how their money is spent and how it's taxed. Billionaires know that there's two main categories of taxation: income tax and capital gains tax. The number one way that rich people avoid paying taxes is by paying themselves the smallest salary possible and then taking that capital that would be income and cramming it back into their business and into assets such as real estate. And the way that the system is set up, when you invest back in your business, you get write-offs, and then when you invest into real estate, you get depreciation. And then when they want to buy something, instead of selling their assets and paying capital gains tax, they use their assets as collateral and they get loans against them to fund whatever it is that they want to buy. And since loans are debt and debt isn't taxed, they can now buy whatever it is that they want or invest in whatever it is that they want tax-free.
All right, so it sounds really like highfalutin and cool. It's not actually that. It's not that difficult. What billionaires do is they end up with a lot more assets than they need to actually live off of, because our living expenses are going to be fairly finite. There's only so much you could spend. So let's just say that they're spending, and this is probably accurate with most billionaires that I've worked with, maybe 10% of the money that they're bringing in. Most of it they're trying to shelter and keep from paying tax on. And one of the beautiful things about capital gains is you only pay capital gains tax when you sell the asset or liquidate the asset. So you can borrow against those assets. It's what Elon Musk has done with Tesla and other multiple people, not just billionaires, but millionaires and even 100,000aires. They'll have a asset, let's say a house, and will borrow against it. So this could be your own home, and you take a home equity line of credit. That is a non-taxable loan. And yes, you could go out and you could put that into a business. You could put that into other assets, and you could grow them. You could go and invest it and grow it. And if you're making better than what the cost of the loan is, then you're actually making good money. And if you're investing it, you get to deduct the interest that you're paying on that investment loan. So yes, there's a whole bunch of things, but it's not as difficult as he makes it sound. It really is quite simple, which is minimize the amount of tax you're paying and invest in assets. If he just said that, I'd be right there with him.